Welcome to Iron Financial. This is the show where we help you forge a stronger portfolio and cut right through all that market weakness. I'm your lead analyst. Today, we're putting on the hard hats, we're grabbing the blueprints, and we are examining the structural integrity of a huge player in the IT services world, Cognizant. And let me tell you, this is one of the most fascinating cases I've seen in a while, because what we've got here is a major disconnect between how the company is performing and how the market is reacting. You look at the numbers, and it looks like a steel-framed skyscraper. Solid, impressive. But you look at the stock chart, and it tells you some investors think it might just be a house of cards ready to tumble. Our job today, we're going to stress test this thing. We're going to find out if that foundation is solid rock or if it's sitting on sand.
Whoa, hold on. Before we even lay the first brick here, we have to talk about the elephant in the room. Just look at this slide. It tells the entire story in 2 columns. On the left, you've got a report card that, honestly, most companies would kill for. Cognizant beat revenue expectations. They beat earnings per share, and not by a little, up 11% year over year. They gave the market strong guidance for the year ahead, and they announced a record number of massive new deals. I mean, by any normal measure, that is a home run, a grand slam even. But then you look to the right. How did the market react to this incredible news? It punished the stock, sent it down 7%. That's not a round of applause. That's a vote of no confidence. It doesn't add up.
And that, right there, that is the billion-dollar question, isn't it? What is Wall Street seeing that these fantastic headline numbers aren't showing us? There's something hiding under the surface, and it's our job to go digging. We are going to get into the blueprints. We're going to inspect every single weld, and we're going to figure out if the market is right to be so nervous, or if this big sell-off just created a massive buying opportunity for the rest of us. So let's break it down piece by piece, and we're going to start by building the bull case from the ground up.
All right, let's get to work. Before we even think about looking for cracks, we have to understand the structure we're dealing with. So we are going to forge this bull case from the ground up, starting with the hard, cold numbers. These are the steel beams, the load-bearing walls that are supposed to be supporting this entire investment thesis. And trust me, when you see them, you'll agree. These are some heavy-duty materials. This right here is the foundation. You always start with the foundation. $28.4 billion. That's their trailing 12-month bookings, up a solid 5% year over year. Now, you got to understand what bookings really means. This isn't revenue they already made. This is the total value of contracts they've already signed. It's a massive locked-in pipeline of future revenue. It gives them incredible visibility into what the next year, maybe even 2 years, is going to look like. And get this, their book-to-bill ratio is sitting around 1.3x. What that means in plain English is that they are signing new business 30% faster than they are recognizing their current revenue. That is an incredibly powerful forward-looking indicator of strength. It's a sign of momentum.
And where is that massive booking number coming from? It's coming from a company that has turned into an absolute deal-making machine. In 2025, they signed 28 large deals. We're talking contracts worth over $100 million each. But here's the key, the part you can't miss. It's the acceleration. Look at step 2. 12 of those deals, nearly half of the entire year's total, were signed in the 4th quarter alone. The momentum is not just there, it's building, it's speeding up into year-end. And we're not talking about small projects here. Step 3 shows they locked in 5 mega deals, each valued at over $500 million. One of those was an expansion of a partnership with a financial services client worth another $1 billion. This isn't just steady growth. This is high-value, accelerating, blockbuster growth. And listen, this isn't one of those companies that's just chasing revenue at any cost, sacrificing profits for growth. No, they are delivering where it really counts for us as shareholders, on the bottom line. Full-year adjusted earnings per share grew by a really powerful 11%. That tells me there's some serious operational discipline going on behind the scenes. It means they're managing their costs, they're improving their efficiency, and they are converting that massive top-line growth into actual tangible profit. This is the sign of a healthy, well-oiled machine that isn't just getting bigger, it's getting stronger and a whole lot more profitable. And look, you don't just have to take my word for it. Let's listen to the man in charge, the CEO, Ravi Kumar. He came out on the earnings call and basically declared victory. He said that Cognizant has officially returned to the winner circle. And get this, 2 years ahead of the schedule they laid out at their own Investor Day. Now that is an incredibly bold, incredibly confident statement. He's not just saying, hey, things are going pretty well. He's saying they are absolutely crushing their own ambitious plans and are now standing shoulder to shoulder with the best in the business. That's a leader who believes the structure he's building is rock solid. He just keeps doubling down on that confidence with this quote here from the call. The foundation is set. I believe the boldest chapters of our story are still ahead. So, okay, let's piece it all together. You've got record bookings creating a solid pipeline. You have accelerating mega deals that are bringing in huge amounts of revenue. You've got double-digit profit growth showing operational strength. And you have supreme, almost unwavering confidence from the leadership team. When you look at it from this angle, the bull case looks incredibly robust. Cognizant looks less like a house of cards and a lot more like a fortress.
A fortress? Okay, let's pump the brakes a little bit. Every impressive-looking structure needs a proper stress test. You know, a steel frame might look great from a distance, shimmering in the sun, but you have to get up close. You gotta check the welds. You gotta look for those little hairline fractures that could turn into catastrophic failures when the pressure's on. So I think it's time we put this so-called fortress, this bull case, through a proper inspection and see if we can find those hidden weaknesses that the market is so clearly freaking out about.
You know, you're right to be skeptical. The bull case is a solid story. It's compelling. But there are absolutely potential cracks in the armor. That 7% drop in the stock price, that wasn't an accident. It wasn't random. That was a reaction from very smart, very sophisticated investors who know how to read between the lines of an earnings report. They're not just ignoring the good news. They're weighing it against the risks. So let's do what they did. Let's dig in and find out what they're so worried about.
Okay, the first crack, the first sign of trouble, appears in the gross margins. They actually went down year over year in the fourth quarter. Now, of course, management has explanations. The first one is higher variable compensation. Basically, they had to pay out bigger bonuses because the company had such a great year. And you know what? Fine. As one analyst on the call pointed out, that's a good problem to have. But the second factor here is a lot more concerning because it's structural. Their big acquisition, Bilcan, while it's adding a lot of revenue, is also diluting their overall margin profile. Why? Because Bilcan's business requires more on-site work, which is just fundamentally less profitable than remote work. This isn't a one-time bonus payment that goes away next year. This is a permanent change to the company's cost structure.
And this might be the single biggest risk that investors are trying to wrap their heads around. The very nature of Cognizant's business is changing under their feet. Right now, about half, 50% of all their contracts are either fixed price or success-based. This is a massive, fundamental shift away from the traditional time and materials model they used for years. In this new fixed-price world, all the risk shifts. It's Cognizant, not the client, that's on the hook for cost overruns and delays. They promise a client, we'll deliver this project for X amount of dollars. If they mess up, if they miscalculate, that loss comes directly out of their pocket. This is a high-wire act, and it requires absolutely flawless execution. There is no room for error. So let's just lay out these core risks as clearly as we can. First and most importantly is that execution risk on the fixed-price contracts. One bad project, one mismanaged deal can literally wipe out the profits from 10 good ones. Second, there's this idea of a productivity lag. See, Cognizant is pricing these new deals with the assumption that they can generate massive savings and efficiencies using AI. But what if those savings take longer to actually show up than they promised the client? Well, you get this lag where your costs stay high, but your pricing is already locked in at a low number. That's a recipe for crushed margins. On top of that, they've admitted that smaller, discretionary projects are still soft. So now the company is incredibly reliant on these huge mega deals ramping up perfectly and on time. Any delay, any hiccup could cause them to miss their growth targets. So no, this foundation isn't flawless. It has some very, very real stress points. And you've laid out those risks perfectly. I mean, they're real and they're significant. But those pressures are precisely why the company's strategy around AI is so absolutely central to this whole story. They aren't just ignoring these risks and hoping for the best. They believe they have the ultimate tool to overcome them. For Cognizant, AI isn't just a buzzword they're throwing around to impress investors. They see it as the powerful engine that's designed to do all the heavy lifting, to help them manage those risky fixed-price contracts profitably, and to completely eliminate that productivity lag you were just talking about. And again, the CEO has been crystal clear about this. He said, our mission is to be the AI builder, bridging this gap to enterprise value by converting the technology to measurable returns. What he means is they're positioning themselves as the one indispensable partner that can help these giant, complex, old-school companies move beyond just playing around with AI and actually use it to generate real-world savings, real-world innovation. This is their strategic answer to every single risk you just outlined. Their plan is to use AI to price their deals smarter, execute on them more efficiently, and deliver so much value that it justifies their contracts. And you know what? This isn't just some promise about the future. We have hard data right here that shows this engine is already firing on all cylinders. Just look at this chart. In the last 12 months, the revenue per employee has increased by 5%. That's good. But look at the second bar. This is the one that really matters. The margin per employee is up a whopping 8%. This is concrete proof. This is evidence that their productivity initiatives are actually working. They are making each and every one of their 350,000 employees more efficient and more profitable. This is the heavy lifting happening in real time, and it's the most powerful counter-argument to the bears who are so worried about margin pressure.
But is it enough? I mean, really, is it? Is this AI engine truly doing the kind of heavy lifting that's needed to offset the enormous risks of having half your business in these fixed-price contracts? Or is this just a new shiny coat of paint on the same old IT services model? Let's be honest, every single company in the S&P 500 is tripping over itself to talk about AI right now. The market's skeptical reaction to Cognizant's great quarter tells me that it's questioning whether this AI story is one of genuine, defensible transformation or if it's just really well-packaged market hype. That right there is the core of this entire debate.
That's a fair challenge, a very fair challenge. So, to help settle it, let's turn to the company's own forecast. This is their official blueprint for 2026. This isn't our analysis, this isn't some analyst's speculation. This is the guidance that management has put their names on, put on the line for everyone to see. Let's dig in and see if these numbers reflect confidence in their AI engine or if they're showing caution. All right, let's break this guidance down. For 2026, they're guiding for revenue growth of 4 to 6.5% in constant currency. That just means they're taking out the unpredictable effects of foreign exchange rates. So that's solid, stable growth. Now look at the second row. This is crucial. They expect their adjusted operating margin to expand. That's a technical way of saying they expect to become more profitable. This is management looking you in the eye and saying, yes, we see the margin pressures and we believe we can handle them. And maybe the most important point is in the third row, adjusted EPS growth of 5 to 8%. They are telling the world they expect their profits to grow faster than their revenue. That, my friends, is the very definition of operating leverage, and it's a direct signal of their confidence that this AI-driven productivity is real. You know, it's a solid blueprint. I'll give them that. The numbers, on paper, project a lot of strength. But a blueprint is just a plan. It's just a piece of paper. The real question, the reason we are here at Iron Financial, is what's the final verdict? When you put everything on the scales, the solid steel beams of the bull case against the very real stress points of the bear case, is Cognizant an opportunity for investors to build on, or is it a trap waiting to spring? So let's put it all on the scales, right here, right now. On one side, you have the steel beams of this company, the undeniable massive deal momentum, those record bookings providing a solid foundation for future growth, and strong double-digit EPS growth that's being fueled by an AI strategy that is already showing real results. But on the other side of that scale, you cannot ignore the stress points. You've got tangible margin headwinds, the immense execution risk that comes with fixed-price contracts, a continued softness in smaller discretionary spending, and a market that is just deeply, deeply skeptical. Both sides of this argument have some serious weight to them. And yet, after weighing all of those risks, it is really worth looking at where the professional models land. Now, this is a third-party valuation model from Ticker, and it uses the consensus estimates from all the Wall Street analysts that cover the stock. After all their number crunching, it calculates a fair value target price of about $100 per share. What this suggests is that despite all the very real risks we've just talked about, the professional analyst community as a whole believes the strengths are ultimately going to win out. And that, right there, puts the investor's dilemma into really sharp focus. A $100 price target implies a potential 30% upside from where the stock is trading today. The reward, it's clearly there on paper, it's significant. But, and this is a big but, to actually achieve that return, the company has to prove its structural integrity. It has to execute flawlessly on those risky contracts and prove to a skeptical world that its AI engine is more than just marketing hype. That is the bet an investor is making today. Which brings us to our final question, the one we want to leave you with. Cognizant is, without a doubt, building an AI-powered fortress. They are leveraging their incredible scale and their deep industry expertise to try and capture what could be a multi-trillion-dollar opportunity in this new age of AI. The question is this, is that fortress being built on the solid rock of genuine productivity gains and flawless operational execution, or is it being built on the shifting sands of market hype and contracts that carry way too much risk? That's the crucial question you have to answer for yourself before you decide to add this stock to your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.